A Man for All Markets, From Las Vegas to Wall Street, How I Beat the Dealer and the Market, by Edward O. Thorp. Introduction. He was a math professor, not a spy. He was in a Las Vegas casino, one of the grand, velvety palaces of chance on the Strip. And he was winning. But as he sat at the baccarat table, a strange fog began to creep into his mind. The numbers, usually so clear and crisp, started to blur. He couldn't keep the count. It was a feeling he'd never had before, not through the noise, the smoke, or the pressure of betting thousands of dollars on a single hand. Something was wrong. His wife, watching from a distance, saw it in his eyes. His pupils were huge, dilated like black saucers. A friend, who was a nurse, recognized the signs immediately. "He's been drugged," she whispered. They rushed him out of the casino, away from the smiling staff and the free cups of coffee they had been so eager to serve him. They spent the next several hours walking him, forcing black coffee down his throat, trying to fight whatever substance was trying to shut his mind down. This wasn't a scene from a James Bond movie. This was a Thursday night in the life of Edward O. Thorp, a quiet academic who had committed the one unforgivable sin in the world of gambling. He had found a way to win. And the house, it seemed, was willing to do anything to stop him. Welcome, my friend, to one of the most remarkable stories of the 20th century. We're diving into the mind of a true genius with the book, A Man for All Markets, written by the man himself, Edward O. Thorp. This isn't just a book about gambling or investing. It's a manual for how to think. It's the story of a man who looked at the world, from the casinos of Las Vegas to the trading floors of Wall Street, and saw it as a series of puzzles waiting to be solved. While everyone else was following their gut, their superstitions, or the conventional wisdom, Thorp was following the numbers. His book, Beat the Dealer, published in 1962, literally changed the game of blackjack forever by introducing the world to card counting. He then built the world's first wearable computer with a legendary Claude Shannon to beat roulette. And when he got bored of beating casinos, he turned his attention to the greatest casino on earth, Wall Street. He launched one of the first ever quantitative hedge funds, using mathematical formulas to make millions while taking almost no risk, long before anyone had ever heard the word quant. By the end of our journey today, you're going to understand the fundamental mindset that allowed one man to consistently find an edge in systems that were designed to be unbeatable. You'll learn the secret of how to think for yourself, how to manage risk, and most importantly, how to see the hidden rules that govern so much of our world. This is more than just a summary. It's a look inside a mind that changed the game forever. So, let's begin. Book summary. The story of Edward O. Thorp doesn't start in a glittering casino or on a high-stakes trading floor. It starts with a simple, powerful discovery he made as a child growing up during the Great Depression. As he put it, "I learned how to think." While other kids might have taken the world as it was presented to them, young Edward had an insatiable need to test things for himself. When his mother told him not to touch a hot stove because it would burn him, he had to know for sure. He brought his finger closer, felt the warmth, and then pressed his hand against it. He got burned. And he never did it again. When he was told that a fresh egg would crack if squeezed just a little, he had to find out what a little bit meant. He squeezed one slowly until it broke, and then practiced on another, stopping just short, to understand its limits. This wasn't disobedience, it was a fundamental part of his character. He was largely self-taught, which led him to think differently. He never accepted conventional wisdom at face value. While the world said, "You can't beat the casinos," his mind said, "I'll check for myself." This simple habit, of testing reality for himself, would become the cornerstone of his entire life. His playground wasn't just made of swings and slides, it was made of science. He was fascinated by the idea that the world, even the parts he couldn't see, followed rules. He built a primitive crystal radio from wire and headphones and was mesmerized as voices traveled hundreds of miles through the air, carried by some invisible process. To him, the universe was a collection of beautiful, logical models. A street map was a model of a city. The idea of a gas being a swarm of tiny bouncing balls was a model. And if you could understand the model, you could predict what would happen. You could change the world. This love of experimentation sometimes got him into trouble. He started a chemistry lab in his family's garage, a space filled with the constant smell of fumes and the occasional sound of an explosion. He found a recipe for gunpowder in an encyclopedia and accidentally ignited a batch, burning his hand to a brittle, black crust. He moved on to making nitrocellulose, or gun cotton, in the family refrigerator, leaving a "don't touch" sign that his family knew meant serious business. He even made nitroglycerin, the notoriously unstable explosive. One day, while heating less than a single drop on a glass tube, it exploded with a violent crack, embedding tiny shards of glass in his hand and arm. These weren't just the reckless acts of a curious teenager. They were how he learned. He wasn't just reading about science, he was doing it. He was building an intuition for how the world worked, not from a textbook, but from direct experience. This hands-on, first principles approach was the software he was building for his brain, and he would soon find the perfect place to run it: Las Vegas. For most people, a casino is a place of luck, superstition, and hope. For Edward Thorp, it was a laboratory. It was a massive, real-world system governed by a set of mathematical rules, and he was convinced that those rules could be understood and, more importantly, beaten. His journey into this world began not with a grand scheme, but with a quiet curiosity. In 1958, during a Christmas holiday trip to Las Vegas with his wife, Vivian, he decided to try his hand at blackjack. He wasn't there to get rich, he was there to gain experience. He had read an article by 4 mathematicians who had devised a strategy that reduced the casino's edge to just 0.62%, the best odds of any game in the house. He condensed their strategy onto a tiny card that he could hold in his palm. As he sat down at the table, with a humble stake of $10 silver, the other players and even the dealer looked at him with amusement. He played slowly, deliberately, consulting his little card before every move. The onlookers snickered. Who was this fool who would stand on a pitiful total of 12 against a dealer's 4? Who would split a pair of 8s, doubling his bet, when the dealer was showing a powerful ace? He was breaking all the unwritten, superstitious rules of the table. But then, something strange happened. He started to hold his own. The ridicule from the bystanders slowly turned into quiet respect, and then, after one particularly bizarre and lucky hand where he drew to a 7-card 21, it turned into awe. In the end, he lost $8.50 of his $10 stake, but it didn't matter. He was hooked. He had seen something crucial that day. The atmosphere of ignorance and superstition at the table convinced him that even the so-called good players didn't truly understand the mathematics of the game. They were playing based on gut feelings and old wives' tales. He knew he could do better. Back at the UCLA library, he had his eureka moment. While rereading the paper from the 4 mathematicians, he stood there among the bookshelves and suddenly saw it. The strategy he had used assumed that every card in the deck had an equal chance of being dealt. But that wasn't true. As cards were played, the composition of the remaining deck changed. Think about it this way. A deck of cards has a fixed number of high cards like aces and tens and low cards. If the first few hands dealt are full of low cards, what does that mean about the rest of the deck? It means the remaining cards are now disproportionately rich in high cards. And a deck that is rich in aces and tens is very, very good for the player. Why? Because blackjacks an ace and a 10 pay a bonus of 3 to 2, and the dealer is more likely to bust when hitting on a stiff hand like 16. The odds were not fixed. They were constantly shifting, swinging back and forth between favoring the casino and favoring the player. And if a player could keep track of the cards that had been played, he could know when the odds were in his favor. When they were, he could bet big. When they weren't, he could bet small. Over time, he would win more on his big bets than he lost on his small bets. He would have an edge. The mathematical proof that winning systems were impossible only applied to games where the odds never changed, like roulette or craps. Blackjack was different. It had a memory. Every card that was dealt changed the probabilities for the next hand. This was the flaw in the casino's armor. But the challenge was immense. To calculate the optimal strategy for every possible combination of remaining cards would take a human lifetime with a desk calculator. We're talking about millions of different scenarios. It was an impossibly large library of strategy tables. This was 1959. And Thorp, now a young professor at MIT, had a new powerful tool at his disposal, the IBM 704 mainframe computer. It was a noisy, electromechanical beast that filled a room, but it could perform calculations at a speed that was unimaginable just a few years earlier. He taught himself how to program it in a language called Fortran and set to work. Night after night, he would pound the calculators in a nearly deserted building, his fingers flying over the keyboard, turning his theoretical insight into a practical, winning system. The computer churned through the numbers, doing what would have taken 1,000 man-years of hand calculations in just 10 minutes. The results confirmed his theory, and with a staggering clarity. Removing the 4 fives from a deck gave the player a huge edge of over 3%. Removing aces was terrible for the player, shifting the advantage heavily to the casino. Every card had a specific value. He could assign points to each card as it was played, a simple system of +1 for low cards, -1 for high cards, and 0 for the rest. This was the birth of card counting. With this knowledge, he was ready to prove his theory in the real world. He teamed up with 2 wealthy New York businessmen, whom he called Mr. X and Mr. Y, who agreed to provide a $10,000 bankroll for a trip to Nevada. One of them, a man named Manny Kimmel, was a short, white-haired 65-year-old in a long black cashmere coat who showed up at Thorp's Cambridge apartment one winter afternoon with 2 beautiful young blondes he introduced as his nieces. Thorp's wife, Vivian, could see from their expressions that they were no more his nieces than she was, but Thorp, focused on the math, took him at his word. This was his first introduction to the colorful, and sometimes dangerous, characters who inhabited this world. In April 1961, they went to Reno. Thorp started with small bets, from $1 to $10, to get comfortable. He was calm, disciplined, and accurate, a lesson that would prove invaluable later in his investment career. But Manny, his backer, was agitated, used to betting tens of thousands of dollars a night. After 8 hours of play, Thorp was down $100, and Manny was close to giving up on his secret weapon. Then, at 3 a.m., with the casino nearly empty, he finally got a table to himself. Annoyed by an unfriendly dealer, he raised his bets to the $2 to $20 range. The deck turned favorable. He won, and then won again. In a few hands, he had recouped all his losses and was slightly ahead. The system worked. The next day, playing for higher stakes, from $50 to $500, the wins started to pile up. At one point, they were at the famous Harold's Club, playing in a private area upstairs. After winning just $500, the owner, Harold Smith, Sr., came in to watch. The casino was getting nervous. They started shuffling the deck more frequently, after just a few hands, to disrupt his count. This was the first of many countermeasures the casinos would invent to fight back. The trip was a series of dazzling streaks and nerve-wracking losses. At one casino, after losing steadily for hours, he was down $1,700. He was discouraged, but he persisted, waiting for the deck to turn favorable one more time. It finally happened. The count gave him a 5% advantage. He made the maximum bet of $300. He was dealt a pair of eights, a terrible hand. But the strategy was clear. Split them. He threw another $300 on the table. Then, on one of his new hands, he was dealt a 3, for a total of 11. The right move was to double down. He dropped another $300. He now had $900 on the table, the largest bet he had ever made. The dealer, showing a 6, busted. Thorp won both hands for a $900 gain, wiping out half his losses in a single play. Within minutes, he was ahead for the session. In just 30 hours of play, their $10,000 bankroll had grown to $21,000. The experiment was a success. The theory, born in a library and tested in a computer, worked perfectly at the green felt tables of the real world. A casino spokesman had once scoffed at his system, saying, "When a lamb goes to the slaughter, the lamb might kill the butcher." But we always bet on the butcher. Thorp had proven him wrong. The day of the lamb had come. But blackjack was just the warm-up. While he was perfecting his card-counting system, Thorp had another, even more audacious idea. He believed he could predict the outcome of a roulette wheel. This was a problem on a whole different level. Unlike blackjack, roulette has no memory. Each spin is independent of the last. The odds are fixed, and they are permanently in favor of the house. Mathematicians, including the great Henri Poincaré, had proven that physical prediction was impossible. But again, Thorp's instinct was to check for himself. He saw the analogy between a circling roulette ball and an orbiting planet. Since planetary positions were predictable, why not a roulette ball? He brought this idea to the one person at MIT who might understand, Claude Shannon, the father of information theory. It was a meeting of minds that would make history. Shannon, a legendary gadgeteer who kept a workshop in his basement that was a paradise of electronic and mechanical parts, was immediately intrigued. For 9 months in 1960 and 1961, they worked together, spending 20 hours a week in Shannon's home. They bought a regulation roulette wheel and set it up on a massive billiard table. Their plan was simple in concept, but incredibly difficult in execution. They would build a tiny, concealed computer that could time the speed of the spinning ball and the rotating rotor, and use those measurements to predict which section of the wheel the ball was most likely to land in. The person wearing the computer would time the rotor and the ball by tapping a microswitch hidden in his shoe with his big toe. The computer, just the size of a pack of cigarettes, would then calculate a prediction and transmit it by radio to a second person, the bettor. The bettor wore a tiny speaker in his ear canal, which would play a series of musical tones indicating where to place the bet. It was, in essence, the world's first wearable computer, built in 1961. Their calculations showed they could gain an enormous 44% edge on every bet. In August of 1961, Thorp and Shannon, along with their wives, Vivian and Betty, went to Las Vegas to test their device. The four of them walked into a casino, acting as strangers. Claude stood by the wheel, pretending to be just another system player writing down numbers, while secretly tapping his toe to time the spins. Thorp sat at the far end of the table, listening for the tones in his hidden earpiece. It worked like magic. Betting with 10-cent chips just for the test, he quickly turned small piles into large ones. But they had problems. The tiny wires to the earpiece kept breaking, forcing them to return to their hotel room for tedious repairs. And at one point, A woman sitting next to Thorp looked over in horror as she saw the tiny speaker peeking out from his ear like an alien insect. They knew they could solve the technical problems. They could use larger wires and grow their hair out to cover them. They could win millions. But as they talked, they realized something important. To successfully exploit their invention, they would have to live a life of deception. They would need disguises, elaborate acts, and constant misdirection to keep the casinos from figuring out what they were doing. And the casinos had a very simple way to stop them: just call no more bets before the ball was spun. It simply wasn't the way any of the four of them wanted to spend their time. With some ambivalence, they put the project aside. It was a profound lesson in understanding what a game is worth. It wasn't just about the money, it was about the life they would have to lead to get it. Having conquered, in theory and in practice, the two most iconic casino games, Thorp's restless mind began to look for a bigger challenge. He found it in a place that, to him, looked strikingly familiar. As he put it, he realized there was a far greater casino than all of Nevada. The greatest gambling arena on earth, Wall Street. Just as with gambling, Thorp approached the stock market not as an insider, but as a mathematician looking for an edge. And just as with gambling, his first experiences were humbling lessons in what not to do. He heard a story about a company called Electric Autolight, whose stock was supposedly a bargain. He bought 100 shares at $40. Over the next 2 years, he watched it fall to $20. He made a classic amateur mistake. He decided to hold on until the stock got back to what he paid for it, so he wouldn't have to take a loss. This behavior, which psychologists now call anchoring, is what gamblers do when they're losing and insist on playing until they get even. He was anchoring himself to a price that had historical meaning only to him, but no meaning to the market. It took 4 years, but he finally sold at his original price, having learned a valuable lesson about emotional investing. His next mistake came from believing in momentum. He invested in life insurance companies because he was told their stocks had gone up for 24 straight years. Sure enough, the streak ended right after he bought in, and he lost money. The lesson: past performance is no guarantee of future results. You need a sound reason to believe a trend will continue. Then came a painful lesson in leverage. Believing the price of silver was destined to rise, he opened a Swiss bank account and bought silver on margin. For every dollar's worth he bought, he only had to put up 33 cents, borrowing the rest from the bank. When silver rose, his profits were magnified. He was a genius. He used his profits to buy even more silver, leveraging himself further. But when the price took a sudden dip, the leverage worked against him. The small drop was magnified into a huge loss, and he was completely wiped out. He had been right about the long-term trend of silver, but he had failed to properly manage his risk. It was a mistake he would never make again, and a lesson that the entire world financial system would fail to learn before the crisis of 2008. After paying his tuition to Mr. Market, as the great investor Benjamin Graham called the irrational mood swings of Wall Street, Thorp was ready to get serious. In the summer of 1964, he stumbled upon a thin pamphlet about something called a common stock purchase warrant. It was a revelation. A warrant, he learned, is a security that gives you the right to buy a company's stock at a specified price before a certain date. For example, a warrant might let you buy a share of a company for $28 anytime in the next 3 years. If the stock price goes to $40, that warrant is worth at least $12, because you can use it to buy a $40 stock for only $28. If the stock price is below $28, the warrant might seem worthless, but it's not. Like a lottery ticket, it always has some value as long as there's time left and a chance the stock could go up. What fascinated Thorp was the mathematical relationship between the price of the warrant and the price of the stock. They moved together, but not perfectly. And in that imperfection, he saw an opportunity. The idea of hedging occurred to him. He realized he could buy the stock and sell short the warrant, or vice versa. If he chose the proportions correctly, the gains on one side of the trade would roughly offset the losses on the other, no matter which way the stock price moved. He would be protected from the wild swings of the market. His profit would come not from guessing which way the market was going, but from exploiting the temporary mispricing between the warrant and the stock. When that mispricing corrected itself, as it almost always did, he could close both positions and pocket the difference. He had found his edge. This was the birth of what would come to be known as quantitative, market-neutral investing. Soon after, he discovered that a fellow professor at the newly formed University of California, Irvine, an economist named Sheen Kassouf, had independently discovered the same ideas and was already using them to double his money every few years. They teamed up, and their collaboration eventually led to their groundbreaking 1967 book, Beat the Market. But Thorp took the theory a step further. In 1967, using what he called plausible and intuitive reasoning, he derived a neat formula for determining the correct price of a warrant or an option. Armed with this formula, he could see with mathematical precision when a security was mispriced and by how much. This was the very same formula that Fisher Black and Myron Scholes would rigorously prove and publish a few years later, a discovery that would win them the Nobel Prize and launch the multi-trillion-dollar derivatives revolution. But in 1967, Thorp was using it to trade from his office at UCI, years ahead of Wall Street. His success managing money for friends and colleagues, including the dean of the graduate school, eventually led him to a fateful dinner party in the summer of 1968. There, he was introduced to a rising, 38-year-old investor from Omaha, Nebraska, Warren Buffett. The two men hit it off immediately, bonding over a love of numbers, logic, and games. Warren challenged Thorp with a puzzle about a strange set of 3 dice. Unlike normal dice, these were non-transitive. This means die A beats die B, and die B beats die C. But, and here's the twist, die C beats die A. It defied intuition, just like the game of rock, paper, scissors. Thorp, of course, solved the puzzle, impressing Buffett with his quick analytical mind. As they talked, the differences in their investment philosophies became clear. Buffett was a value investor, in the mold of his mentor Ben Graham. He looked for wonderful businesses that were selling at a cheap price, what he called cigar butts. You could pick one up off the street and get one last free puff. He believed in being fearful when others are greedy and greedy when others are fearful. Thorp, on the other hand, didn't try to judge the worth of a business. He was a relative value investor. He compared different securities of the same company to find mispricings, and then constructed hedged positions that would make money whether the market went up or down. Buffett was betting on the long-term success of American business. Thorp was betting on mathematical certainty. The meeting helped solidify Thorp's path. He decided to pool his investing into a single limited partnership, just as Buffett had done. In 1969, he teamed up with a young New York stockbroker named Jay Regan, and they launched Convertible Hedge Associates, later renamed Princeton Newport Partners, or PNP. It was one of the very first quantitative, market-neutral hedge funds. While most of Wall Street was making directional bets on the market, PNP was using computers, mathematical formulas, and hedging techniques to generate steady, high returns with incredibly low risk. Their timing couldn't have been better. Their first severe test came during the brutal bear market of 1973-74. As the Arab oil embargo sent shockwaves through the economy, the S&P 500 fell by a devastating 48% from its peak. Investors who had put $1,000 in the market saw it shrink to just $618. Warren Buffett himself said it was a good thing he had closed his partnership when he did. But Princeton-Newport partners sailed through the storm. While the market was collapsing, their investors gained over 15%. Their $1,000 grew to $1,160. They made money in every month of their first 6 years, except for one tiny loss of less than 1%. They were a revolution on Wall Street. Their office in Newport Beach became a beehive of activity, with students from UCI collecting data, plotting it on mathematical diagrams, and feeding it into computers that hummed day and night. They were the original quants, using science and technology to beat the market, long before it became fashionable. PNP's success continued for nearly 2 decades. From its humble start of $1.4 million in 1969, it grew to manage hundreds of millions, with investment positions totaling over $1 billion. Over its entire lifetime, it never had a losing year, or even a losing quarter. An initial investment grew more than 14-fold for the limited partners, an annualized return of over 15% after fees, with far less volatility than the stock market. But it all came to a dramatic and tragic end. In December 1987, as part of a sweeping Wall Street crackdown led by the ambitious U.S. Attorney Rudolph Giuliani, about 50 armed federal agents raided PNP's Princeton, New Jersey office. They seized hundreds of boxes of records, dug through wastebaskets, and crawled through ceiling spaces. Giuliani's real target wasn't PNP. It was the junk bond king, Michael Milken, and other high-profile figures on Wall Street. He believed that Thorp's partner, J. Regan, had information that could help bring them down. When Regan refused to cooperate, Giuliani brought the full force of the government down on them. The 5 top people in the Princeton office were indicted on 64 charges, including stock manipulation and tax fraud, under the powerful RICO Act, a law designed to prosecute mobsters, now being used for the first time against a securities firm. Thorp and his Newport Beach office were never implicated in any wrongdoing, but the damage was done. The legal battle consumed the partnership, and at the end of 1988, facing the relentless pressure from the government, Thorp made the difficult decision to shut it down. Years later, after a long and costly legal fight, virtually all the convictions were overturned on appeal. But the firm, one of the most successful hedge funds in history, was gone. The end of PNP, though traumatic, gave Thorp something he was beginning to value more than money: time. He and Vivian had enough for the rest of their lives. He didn't need to rebuild. He could have retired, but his restless mind was still looking for puzzles to solve. And he found one of the biggest in history. In the spring of 1991, Thorp was hired as a consultant to review the hedge fund investments of a large firm. He went through their portfolio, approving each manager, until he came to one that just didn't add up: Bernard Madoff Investment Securities. The returns were just too good. Madoff was reporting steady monthly profits of 1 to 2%, year after year, with almost no losses. He claimed to be using a complex option strategy, but Thorp knew that strategies should produce occasional losses, especially when the market went down. But Madoff's losing months were magically being turned into winners. Thorp's analytical mind went on high alert. He asked to visit Madoff's operation. He was told he wouldn't be allowed through the front door. He asked who did their accounting. He was told it was a tiny, one-man shop run by a friend of Bernie's. He asked when they received their trade confirmations. The answer was by mail, in batches, weeks after the trade supposedly occurred. The red flags were everywhere. Thorp then did what he always did: he checked the facts for himself. He took about 160 of Madoff's supposed options trades and compared them to the public records from the exchanges. The result was the smoking gun. For half of the trades, no such trades had ever occurred on the exchange on those days. For many of the others, The number of options Madoff claimed to have traded for just this one client exceeded the entire volume traded on the entire exchange that day for everyone. The conclusion was inescapable. The trades were fake. The entire operation was a fraud. It was a Ponzi scheme. He told his client to get their money out immediately. They did. And for the next 17 years, they watched as the rest of the world poured billions of dollars into Madoff's fund, listening to stories of his genius. Thorp warned people in his network, but the scheme seemed too big, too successful to fail. Madoff was a respected figure, a former chairman of the NASDAQ. No one wanted to believe it. It wasn't until December 2008, when the financial crisis starved the Ponzi scheme of new money, that Madoff finally confessed. He had defrauded investors of an estimated $65 billion, the largest financial fraud in history. Thorp had been right, 17 years before the rest of the world caught on. Throughout his incredible journey, from the dusty public schools of the Depression to the heights of Wall Street, Thorp's life offers a set of powerful, timeless lessons. First, and most importantly, learn to think for yourself. Question everything. Test assumptions. The greatest opportunities are often found where conventional wisdom is wrong. Second, understand the power of compound growth. He calls it the eighth wonder of the world. Small, consistent gains, reinvested over time, can lead to astronomical wealth. He tells the story of Ann Scheiber, a frugal IRS auditor who turned a $5,000 investment in 1944 into a $22 million fortune by the time she died at age 101, simply by living frugally and reinvesting her gains. Third, you must understand the trade-offs between risk and reward. He used a mathematical concept known as the Kelly criterion, which provides a formula for how much of your capital to bet when you have an edge. The core principles are simple. The bigger your edge, the more you should bet. The smaller your risk, the more you should bet. It's a disciplined approach that helps you avoid the two great sins of investing: betting too little when you have a huge advantage, and betting too much and risking ruin. And finally, perhaps the most profound lesson of all, is to know how much is enough. Thorp quotes a conversation between the authors Joseph Heller and Kurt Vonnegut at a billionaire's party. Vonnegut pointed out that their host had made more money in a single day than Heller's classic novel, Catch-22, had made in its entire history. Heller's reply was simple: I have something he will never have. The knowledge that I've got enough. Thorp himself chose to step away from running a massive hedge fund, not because he couldn't do it, but because he valued his time more than the extra money. He chose a life of intellectual curiosity, travel, and time with his family over the endless pursuit of more. Life, he says, is like reading a novel or running a marathon. It's not so much about reaching a goal but rather about the journey itself and the experiences along the way. In the end, this man who conquered markets and casinos offers a simple, powerful definition of success. It's not about dying with the most toys. It's about how you spend the one thing you can never get back: your time. Enjoy your life, the people who share it with you, and leave something good behind for the generations that follow. Commentary. As we close the pages of A Man for All Markets, it's easy to be dazzled by the stories, the wearable computers, the battles with casinos, the billions made on Wall Street. But if that's all we take away, we've missed the point. The true genius of Edward Thorp isn't in the specific systems he created. It's in the underlying philosophy that allowed him to create them in the first place. His entire life has been a testament to one powerful idea: that the world is, for the most part, a knowable place. That if you are willing to look past the noise, the superstition, and the conventional wisdom, you can often find a set of logical rules hiding just beneath the surface. And if you understand those rules, you gain a tremendous advantage. This is a book about the power of first principles thinking. Thorp never asked, What does everyone else think about this? He asked. What are the fundamental truths here? What can I test for myself? Whether it was a hot stove, a deck of cards, or a complex financial derivative, his method was always the same. Break the problem down to its essential parts, build a model, test it, and then act with discipline based on what the evidence tells you. For a young person standing at the beginning of their life and career, this is perhaps the most valuable lesson of all. You are constantly being told what to believe, what to study, what career path to follow. Thorp's story is a powerful reminder that your greatest asset isn't your resume or your connections, it's your ability to think independently. So, what can we take from this and apply to our own lives, right now? First, cultivate the habit of intellectual curiosity. Don't just accept answers, question them. When someone tells you something is impossible or just the way things are, let that be a trigger for your curiosity, not the end of the conversation. Read widely, across different fields. Thorp connected ideas from physics, mathematics, and information theory to solve problems in gambling and finance. The most innovative ideas often come from the intersection of different disciplines. Second, learn the basics of probability and statistics. You don't need a PhD in mathematics, but understanding concepts like expected value, standard deviation, and compound growth is a superpower in the modern world. It helps you make better decisions not just in investing, but in health, career choices, and everyday life. It's the language of uncertainty, and learning to speak it protects you from being fooled by randomness, by others, and by yourself. And third, start investing now. Not with a lot of money, and not by trying to outsmart the market. The simplest and most powerful lesson from Thorp's entire journey on Wall Street is that most active investors, after costs, fail to beat the market averages. The easiest way to win is to simply buy a low-cost index fund that owns the whole market, and then let the eighth wonder of the world, compound growth, do its work for you over the next several decades. Start with whatever you can, even if it's just a small amount from a part-time job, and make it a habit. Your future self will thank you for it. A Man for All Markets is more than a memoir, it's an invitation. An invitation to see the world not as a fixed and mysterious place, but as a grand, beautiful puzzle. And it reminds us that with logic, discipline, and the courage to think for ourselves, we all have the power to solve it. That was a deep dive into A Man for All Markets by Edward O. Thorp. We've journeyed through the core ideas and stories today, but I'll be honest with you. A summary can only show you the map. The real treasure is found when you walk the path yourself. The true magic of this book is in the quiet moments of reading, when one of Thorp's stories or a simple, logical insight connects with your own life in a way you didn't expect. This summary is your guide to decide if this book deserves your time. If anything we've explored today has sparked your curiosity or challenged your thinking, I urge you to grab a copy. Reading it isn't just about learning facts, it's an experience that can fundamentally change the way you approach problems and see the world around you. You can find a link to the book in the description below. Also, if you found value in our time together today, please take a moment to hit that subscribe button. We're building a community of curious minds here, exploring the greatest books on the billionaire's bookshelf, and I would be honored to have you join us on our next journey. Let's keep learning and growing together.